The message this week in Global Macros is the rising risk of stagflation in developed markets. Let's begin in the United States, where the macro picture is deteriorating rapidly. Gasoline prices have surged nearly 40% since the war began, contributing to the largest inflation spike in 4 years. And consumers are clearly feeling it. The University of Michigan's preliminary sentiment index collapsed to 47.6 in April, down from 53.3. At the same time, one-year inflation expectations surged to 4.8%, the highest in over a year, reinforced by a New York Fed survey showing the biggest monthly jump in inflation expectations in 12 months. But the real concern is beneath the surface. Consumer spending, adjusted for inflation, rose just 0.1%, extending a prolonged period of weak demand. This is no longer a resilient consumer story, it's stagnation. At the same time, financial conditions are tightening. Short-term credit markets are showing early signs of stress, with spreads widening as investors grow increasingly concerned about liquidity risks tied to a prolonged conflict. And equity markets are reacting. Investors are now demanding the highest risk premium for holding stocks over bonds in more than 2 years, a clear signal that recession or stagflation risks are being priced in. Meanwhile, policy uncertainty is rising. Federal Reserve minutes reveal a growing number of policymakers are open to further rate hikes to combat inflation, even as growth slows. On the fiscal and trade side, tensions are also building. A U.S. trade court is reviewing the legality of a 10% global import tax introduced under the Trump administration, while companies impacted by previously overturned tariffs are now resorting to creative financing, even using expected refund claims as collateral for loans. At the same time, the administration is considering extending sanctions waivers to allow continued purchases of Russian oil, a move aimed at containing energy prices. And geopolitically, discussions around a potential U.S.-China trade board suggest that trade relations could once again become a central macro driver. Even the labor market and education system are not immune. Stricter scrutiny on H-1B visas and cuts to graduate lending programs are adding structural pressure to human capital formation and labor supply. Yet amid all this uncertainty, Wall Street is thriving, at least for now. Equity trading revenues are expected to hit a record $18 billion in Q1, up 14% year over year, highlighting how volatility itself has become a source of profit. Section 2, Global Shock and IMF Warning, 233.30. Zooming out, the global implications are becoming increasingly severe. The IMF has warned that the global economy is ill-equipped to absorb another shock, and estimates that up to $50 billion in emergency funding may be required if conditions worsen. At the heart of this shock is energy. Disruptions tied to the Iran conflict have pushed crude markets into extreme tightness, with US WTI spot premiums reaching all-time highs as Europe and Asia compete for limited supply. This is not just a commodity story, it's an inflation transmission mechanism. And it's feeding directly into global financial conditions. Section 3, China, resilient but fragile, 330.5-30. China presents a more nuanced picture. On one hand, the country is benefiting from the global energy shock. Producer prices have turned positive, rising 0.5% year over year, marking an exit from factory deflation. Electric vehicle exports are booming, up 140% to a record 349,000 units in March, as global demand shifts toward alternatives to fossil fuels. And policymakers appear comfortable holding rates steady, scaling back expectations for easing as the economy shows early signs of stabilization. But beneath this resilience lies deep structural weakness. The property sector remains in crisis, with millions of homeowners now in negative equity, a major risk for both banks and household balance sheets. Chinese lenders are increasingly being forced to intervene to prevent defaults and avoid a broader financial contagion. At the same time, capital flows are becoming volatile. Foreign exchange reserves fell by over $85 billion in March, highlighting underlying pressure. And yet, China continues to build strategic buffers. The central bank has increased gold reserves for the 17th consecutive month, while authorities are issuing additional crude import quotas to ensure energy security. China's relative insulation, supported by reserves and diversified energy sources, contrasts sharply with Western vulnerability to supply shocks. In Europe, the growth outlook is deteriorating quickly. Germany's economic forecasts have been sharply revised lower, with expected growth cut to just 0.6%. Industrial orders are recovering only marginally, rising 0.9%, far below expectations. Bond markets are reacting accordingly. Yields across the Eurozone are falling as traders scale back expectations for ECB rate hikes. In the UK, yields have dropped more than 20 basis points, reflecting rising growth fears. And the stagflation narrative is gaining traction. European officials have explicitly warned that even with a temporary ceasefire, the risk of stagflation remains elevated. Meanwhile, structural shifts are underway. The EU and US are moving closer to a critical minerals agreement aimed at reducing dependence on China, a sign of ongoing supply chain fragmentation. And despite fears of AI-driven job losses, European banks are actually planning to increase headcount by 4%, suggesting that labor market dynamics may remain tighter than expected. Section 5, United Kingdom. Stagflation in real time. 7/8/30. The UK offers perhaps the clearest example of stagflation dynamics. Economic momentum has stalled, with PMI data dropping to 50.3, barely above contraction territory. Cost pressures are surging at the fastest pace in decades, while business optimism is fading rapidly. The construction sector has now contracted for 15 consecutive months. At the same time, policy challenges are mounting. The OECD is urging tax reform to address structural inefficiencies, while the government is being forced to cap student loan interest rates to shield households from inflation. Housing markets are also reacting. Mortgage rates are rising, demand is weakening, and rental markets, particularly in London, are seeing upward pressure due to supply constraints and geopolitical migration flows. Even political stability is being tested, with support for the ruling party dropping sharply in recent polling. Canada is experiencing a similar divergence. On the consumer side, conditions are weakening. Gasoline prices have surged 48% this year, pushing consumer confidence to an 11-month low. Only 15% of Canadians now expect economic improvement. Housing markets are under pressure, with Toronto home prices falling to their lowest level in over 5 years. Retail sectors are also feeling the squeeze, with major grocers downgraded amid rising competition and weaker earnings expectations. But on the commodity side, Canada is benefiting. With disruptions in global supply, Canadian crude is trading at a significant premium in US markets, the highest since late 2023. This divergence between domestic weakness and external strength is becoming a defining feature of the Canadian macro landscape. In Japan, the macro shock is feeding directly into policy expectations. Household confidence has dropped sharply, while inflation expectations are surging, with over 93% of households now expecting higher prices. This is increasing pressure on the Bank of Japan to normalize policy. At the same time, global capital is flowing in. Foreign investors just made the largest ever purchase of Japanese equities, signaling a search for relative safety and opportunity. So where does this leave us? The global economy is entering a far more complex regime. An energy-driven inflation shock, colliding with weakening demand, and amplified by geopolitical uncertainty. For investors, this means one thing: uncertainty persisting for longer. Investors should expect higher volatility, wider dispersion across assets, and increased importance of inflation hedges, energy exposure, and liquidity management. If current trends persists, we are not just navigating a cycle, we may be witnessing a regime shift. If you found this deep dive useful, subscribe for more in macro insights. Because in this environment, understanding the macro isn't optional, it's essential.